We've got another interview here today with Annie de la Chevrotiere with Peak to Peak Mortgage Center. She is out of Squamish. She services Squamish and Whistler. And Annie, why don't you tell us a little bit more about what you do?
Thanks, Dean. I'm an independent mortgage broker. I've been doing this for over 25 years, and I love what I do. And basically, I just try to find financing solutions for clients and look after them and try to navigate the lending environment. Very complex right now. But
Yeah, absolutely. And you do most of the corridor? Do you also do Vancouver business as well?
yes, yeah. Squamish, Whistler, Pemberton, Vancouver. I have clients on Vancouver Island, Nelson, so all over.
That's good. And what about foreign buyers working with people out of province or out of country?
Yes, lots of experience dealing with foreign buyers, and always an interesting element
Yeah.
to clientele. They have unique needs, and a lot of our non-resident buyers appreciate the information that we share in terms of how Canadian mortgages work with fixed rate versus variable, penalty structures, account opening procedures, signing procedures. They rely on us for that kind of information, right? So that when they're buying a home, they have the full picture.
Yeah, absolutely. I've been leaning on your expertise and help for it's probably pushing 20 years now, isn't
Yeah, I think it is.
it?
Yeah,
We've
for
been like a
sure.
little team. We've done a lot of work together.
Yes, we have. Yeah,
Yeah, that's
yeah.
awesome.
Always a pleasure
Um,
with you, Dean.
yeah. Well, I have a couple of key questions, I think, today, mainly surrounding the new environment with interest rates. And then we'll move a little bit maybe into some questions that I know that US investors have surrounding mortgages here. But the big one for now, just to start us off, is it looks like the Bank of Canada recently cut its key interest rate to 0.25%, which I think is the lowest boundary that has ever been seen. I think that's the lowest they're even allowed to go to, correct?
So there's some interesting information on that. So in 2009, the Bank of Canada set the effective lower bound rate at 0.25. So that is correct. But in December 2015, they reviewed their framework for low interest policy, and it was determined that they set the effective lower bound rate to minus 50 basis points as part of their unconventional policy toolkit. So the Bank of Canada has an unconventional policy toolkit to access if necessary in times of emergency. So obviously, if they set the ELB at minus 50 basis points, that would be a very serious situation. The negative interest rate environment is not one that we want to be in.
Yeah.
So interestingly, like if you have money and you have it on deposit, you're earning a little bit of interest, right? And that's a normal scenario. You have money
Yeah.
in the bank, you're earning a little bit of interest, and that'll range depending on what interest rates you're doing. If we get into a negative interest rate environment, now it's actually not to your advantage to have cash in the bank, because it's going to you're actually better off to have cash in your mattress, so to speak, because it's going to cost you to store your money at the bank.
Right.
So that can be problematic in a couple of ways. So if you're actually having to pay a bank to store your money, that's going to provide incentive for you to take your money out of the bank, right? Then you got to run on the banks. That's not a good
Yeah.
scenario.
Yeah. Yeah.
The next thing is that in a negative interest rate environment, it can be helpful for exports, but it's terrible for imports. So it can actually, in a negative rate environment, it's going to hurt your currency. So with a lower currency value, it's going to be more expensive to import goods in, which can put upward pressure on inflation.
Okay.
So you really don't want to see a negative interest rate environment. The Bank of Canada set the 25 basis point ELB as their, what they felt was like a reasonable emergency management situation.
Yeah, which
And
is where we are now.
which is where we are now. Yeah,
Yeah.
exactly.
So with this Bank of Canada key interest rate cut, how does it? What are the mechanics of that sort of trickling down to mortgage rates? Because I've always found that even though that rate gets cut, you don't necessarily see automatically lower interest rates. So how does that work?
Right. So it's important to note that there's two different borrowing vehicles. There's the variable rate world and the fixed rate world. So with fixed interest rates, the fixed interest rates are influenced by what happens in the bond market, the long-term bond yields, the 5 and 10-year bond yields.
Hmm.
Um, the variable rate market is based on prime, but what we're seeing right now is, so the Canadian banks have to borrow money from the Bank of Canada. And at this moment in time, their cost of borrowing from the Bank of Canada has actually gone up because of the demand, the intense demand of short-term money right now. It's very, it's very intense, and it's expensive. So the banks borrowing from the Bank of Canada are, if they're lending to you at prime rate right now, the Scotiabank manager, John Webster, I believe is his name, he's saying that those mortgages are underwater right now. So they're actually costing banks money to provide variable rate financing just at flat prime. That's why we're seeing a premium on the prime rate right now on variable rate mortgages. So you're lucky if you can get prime rate. The pricing is probably going to be prime plus 10 basis points, prime plus 20 basis points. That's reflective of the current cost of funds for the banks to obtain money from the Bank of Canada.
Okay.
So the Office of the Superintendent of Financial Institutions recently made changes for the banks to have less capital. They don't have to have as much capital available to operate. That helps provide liquidity in the market.
Oh, I see.
There's still a cost for the banks to secure funds from the Bank of Canada. And right now that cost of funds is very high.
Okay.
So even though the prime rate has dropped, we're seeing the discounting off the variable shrinking and actually being bonused. And the last time that happened was around the 2008 crisis.
Okay. Okay. With that sort of trickle down, can you maybe give us a bit of context on, in Whistler, let's just put an average purchase price of say $1.2 million on a property. Now that's kind of where a 2-bedroom townhouse in the village sits, or some homes are in that price range as well. So if someone is putting 25% down on a $1.2 million purchase, where are we looking at compared to October this past year as compared to now?
Okay, so I looked that up, and around middle of October, 5-year fixed rate money was around 3%.
Okay.
And right now it's sitting at 3.24.
Hmm.
So about 2 weeks ago, we had a 5-year high ratio insured mortgage at 2.34. But so we were watching the rates fall and the bond yields were coming down, and we're like, oh, wow, this is amazing. 5-year fixed 2.34 for high ratio. And then all of a sudden we're getting emails saying rates are going up. And it was, what? What's
Yeah.
going on? So that's reflective of this, the risk profile in the lending environment right now, with the banks having higher
Oh.
cost of funds.
Hmm.
So even though we're seeing the lower prime rate, the lower bond yields, the lending environment has some risk built into it. And so we're seeing the fixed rates are a little bit higher, and the
Okay.
discounting on that variable is shrinking or eliminated.
So do you think that perhaps that will shift the opposite way once the pandemic scare is over, maybe in a few months?
So we're in unprecedented times right now. I just
Yeah.
listened to a video conference between the head of Dominion Lending, Gary Morris, and Rob McLister, who's the head of Rate Spy, and John Webster, who's the head of Scotiabank. It was a very interesting video conference call. And they all saying, we are in uncharted territory here. This is an event that's happened that is, we don't know what's going to happen. So John Webster from Scotiabank did say that the Liberal government has, without question, taken a very good lead in terms of assisting Canadians through this. And the message has been clear to the banks that they are expecting the banks to be good corporate citizens. So this is a time to try to help Canadians when they can. The mortgage deferral payment programs in place. The government is initiating all kinds of help benefit programs as well to help people get through this. So we are in unprecedented, uncharted water. So in terms of trying to predict what's going to happen with the interest rates, it really is a case-by-case basis right now. They did talk about a V recovery, so, or a V-shaped performance curve on the economy. So we're in the downtrend right now, and they're saying that when the recovery happens, their prediction is that the recovery will be swift.
Mm-hmm.
So how's that going to impact interest rates? The Bank of Canada sets their rate based on inflation, economic activity, overall economic performance. I think it's going to take a while before the economy is recovered enough that we're having to increase rates because of economic growth. Right now, we're seeing higher interest rates because it's part of the risk profile of the current environment. Mm-hmm. So you might see the interest rates kind of flatten out for a while until just to wait and see how markets stabilize. And then just, it's going to be a case by case. So a lot's going to depend on the Bank of Canada. The markets interpret what the Bank of Canada gives them in terms of safety, continuity, consistency, reassurance. When there's a lot of uncertainty, that kind of elevates the risk profile. So that's where we're at right now. There's that uncertainty in terms of what's going to happen in the next couple of weeks with how this viral event is going to play out and unfold. But the one thing that the Scotiabank, the head of Scotiabank did say in the video conference is that you can communicate to your clients that the Canadian banks are here, we're well capitalized, we have a mandate to get consumers through this right now. So that is something that they can rely on.
That's good.
Yeah.
I guess if rates really haven't shifted that much on the mortgage front, perhaps you're not seeing as many people coming in looking for refinancing at current levels, or are you having inquiries to that?
Yes, getting inquiries right now for refinancing, because even so what some people are doing is they're refinancing right now, even taking a variable at prime, because the prime rate is very low. So even if you're borrowing at prime rate, it's still a decent rate right now.
Yeah.
With the idea that once things stabilize, they may sell, they may decide to move, pay off some debt. So they're restructuring right now to get themselves through, the next 12 months potentially as a difficult time. There's the idea that they're going to take variable right now and then potentially lock in once the rate environment stabilizes and then they're comfortable to lock in. So, there's still, whether you choose fixed or variable is still definitely based on your personal risk tolerance and, the penalty risk versus interest rate risk. Are you confident with your income and your financial situation for the next 5 years? If you are, taking a 5-year fixed rate right now is not necessarily a bad thing to do. If you know you're going to be selling in the next couple of years, take a variable. We know there's not going to be a whole lot of upward motion on the prime rate in the next 12 to 24 months. And exiting a variable rate mortgage is easier from a penalty standpoint because it's just a month interest penalty. So it really is an individual case by case.
Gotcha.
Right?
Okay. Yeah, that makes sense. Um, just shifting over to in a normal scenario, pre-COVID or maybe post-COVID, um, what are some of the rules surrounding physical presence for someone getting financing on a property here? I mean, there's quite a few key points in the process where a foreign or maybe an out of town buyer would need to be actually in Whistler for signing documents with a lawyer or opening a bank account. Can you explain a little bit about that?
So most lenders require you to be here physically to sign your closing documents. We have one lender that we work with that will look at out of country signing on a case by case basis, depending on the overall client, where they're from, where they're filing tax returns, how they qualify, if they're working for an international company or if they're self-employed. And if they are self-employed, are their company financial statements prepared by an international accounting firm? So it's all about know your client and stability. So the out of country signing is available, but it's not the norm.
Right.
So yeah, it is a case by case. Yeah.
So for any foreign purchasers right now, even if if they were looking to buy something in Whistler, for example, I'm working with a guy right now out of, gosh, I think he's from Ohio, and he's looking to make an offer on something here in the village, but we need to really look at timing of the transaction and when he can, maybe get up here eventually if he needs to sign anything in person, correct?
So for someone like that, it's going to be like the number one question right now is how can we qualify the application?
Right.
So we obtain an application, the supporting documents, and we see how does the application qualify? What's the level of down payment the client has? What's their credit score? All of that stuff forms part of the overall risk profile of the application. So once we know that, then we know which lender we can work with. And then depending on which lender we're working with will depend on whether or not they have to be here physically to sign, or if we can arrange for it out of country.
Okay. So there's a few kind of avenues we can work through at some point.
Yeah. The number one issue usually boils down to how does the application qualify and what's the level of down payment?
Yeah. Shifting over to stuff like phase two financing. So the phase two condo hotels, they have that restrictive covenant of 56 days a year of owner use, 28 in the winter, 28 in the summer. Typically a little bit of a different kind of animal when you're dealing with those to get them financed. Can you explain a little bit about how that works in your world?
So phase two units they look residential, but they don't fit in the bank's normal residential lending portfolio. They are a unique item because they are operated commercially with short-term like nightly rental income and rental agreements in place with the hotels to manage and everything like that. But people can still use them for their own personal use to a certain degree. So these units do not fit under the bank's typical residential retail banking branch. And but they're too small to be looked at on a commercial basis because commercial financing usually starts in the $500,000 range plus, right?
Right.
So this is why the phase two units are also viewed on a case-by-case basis. We have, again, one lender that will look at financing them under certain qualifying guidelines. And then we have alternative lenders. Alternative lenders will look at financing based on where the clients are from, what kind of the supporting documents available are, what do they want to work with as a down payment. So you can usually arrange anywhere from 50 to 65% financing if we're looking in the alternative lending world, or sometimes up to 80% financing through a solid institutional lender depending on the strength of the application.
Okay. Okay.
Because we did one that closed in February, 80% loan to value, and the clients were from the UK, purchasing in Pemberton.
Oh, okay. Wow. That must have been Pemberton Valley Lodge. It's pretty much the only phase 2 in Pemberton.
Well, that was that one that we did together, you and I. That wasn't a phase 2.
Oh, okay. Okay.
That was that was a townhouse unit.
Oh, right.
Yeah.
Yeah. So, I mean, for us in Whistler as realtors, the phase 2 product is a fairly sizable chunk of the business that we do and the properties we sell here. But I guess to the big banks, it's like a tiny sliver of, you know, any kind of business for them. So it really just fits into a case by case. Right?
Exactly. Yeah.
It really doesn't fit into commercial for them. It fits into the nothing category for them.
It's that unique space, right? And I remember taking around bank executives around Whistler Village and showing them, look at, this is a regular phase 1 unit and this is a phase 2. Look at side by side. You can't tell them apart.
Yeah. Yeah. And they're like, what? Oh, all right. Yeah.
You know, we've tried over the years for sure to get it more popular, or, you know, just more standardized, but yeah. And I guess, like, for the banks lending money to someone when they're purchasing their principal residence, when they're taking a mortgage for the roof over their head, that bears the least amount of risk for them.
Right.
When you get into, you know, the next level is second home. So when someone's buying a property for their personal use, it's a second home. That's also considered kind of low risk. When you get into buying a rental property, or if you have someone that has multiple rentals, that elevates the risk profile, because in times of economic downturn, it's the rental properties that will be, you know, let go first.
Absolutely.
People will do everything they can to keep the roof over their head maintained, right?
Yeah. The first thing they'll walk away from is a condo in a hotel somewhere. Yeah. Well, this sort of ties into the quarter share stuff too, and that's a fairly small segment of the market up here. I personally sell quite a few quarter shares. It's just because I've been doing it for so long. I tend to get the phone calls on those from buyers and sellers. So probably, I guess, over the years from working with you, I've come to realize that really the only hope of getting financing on a phase or on a quarter share really is having a home equity line of credit. Is that kind of what you're seeing?
Correct. Yeah.
That pretty much just taking equity out of another purchase or something you own, maybe your house in the city, and just call it a day.
Yeah, exactly.
Yeah. Okay.
Yeah.
Well, that's great. Well, thank you very much, Annie. It's been a pleasure talking to you, and it's always great for us to get together. And I'd like to maybe continue doing these calls on a regular basis. We could just stay on top of things. I think it would be really great for our viewers, and things change so much in the mortgage landscape and financing that I think that it's probably a good idea for us to do that over the course of the next few months for sure.
Yes.
Yeah.
Happy to check in anytime, and always a pleasure working with you, Dean.
Yeah. Okay. Thanks a lot, Annie. And I'll put a link below this to all of Annie's details, so you can get in touch with her if you're looking for any financing needs in the Sea to Sky corridor. Okay. Thanks again, Annie.
Thank you, Dean. Okay. Bye now.
Bye-bye.